And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
All right, let's talk a little bit about the markets next year. So, there's a couple of things that we need to be aware of going into next year. And this is the problem with the vast majority of analysis that I read. The vast majority of analysis I read is either A or B. It's either next year is going to be a continuation of the bull rally, don't worry about a thing, just stay fully invested, or it's the end of the world. All right, next year, interest rates are going to the moon, the markets are going to crash, and everything's going to be terrible. So you better be in cash or gold or whatever somebody's trying to hawk you. What we need as investors, and this is what we're trying to provide, is just a balanced outlook for next year, saying, hey, here's the positives and the negatives. These are opposing forces that occur in every market. They exist at all times. And one narrative is just winning out over the other for the moment. That's all that occurs in the markets. You've got buyers and sellers. They both believe they're right. It just depends on which group is winning the battle at the moment, right, in terms of supply and demand. So going into next year, this is what we need to be focused on and just understanding what those potential risks are. So from the bullish perspective, right, there's actually some decent things to help support the market. From the bearish perspective, there's also some things you need to be cautious of. Now, here's the interesting thing about this, and this is what we'll get into this morning. It doesn't mean you can't have both in the same year. And we'll talk about why. So, from the bullish case, there's a few things that are going on. First of all, you've got an increase in liquidity coming, right? So the Federal Reserve is going to cut rates next week or this week. So we got the FOMC meeting this week. They're going to cut rates again. They're likely going to cut rates again in March. Economic growth is certainly supportive of that they cut rates. And of course, there's some liquidity stress at the banks that we've talked about in terms of repo and other things that are going on. In fact, it's expected that the Fed is going to buy about $40 billion worth of short-term treasury bills this month. So, there is liquidity support for the market. So going into next year, that liquidity support is going to be important for the bulls. And liquidity is a very, very short-term support for the markets. It's there and then it's gone. So it's got to be one of the things, whether it's continued or not, is going to be important. Secondly, is that regardless of what you think, we're in a bull market and we're not in a recession. And so, hold on. We're not in a recession. We're in a bull market. So if you take a look at when the Fed cuts rates and you're not in a recession, markets tend to do better because you're giving more liquidity and accommodation in a non-recessionary environment. So that leads to more speculative activity, leads to a little bit stronger economic growth. You're helping support activity in the economy, and you're not in a recession, right? And so if you take a look historically, right, when there's no recession, stocks tend to perform better in that environment. So if we've got the Fed cutting rates going into next year and there's liquidity support, you have the basis for a stronger market outcome at the beginning of the year. Also, consumer credit. Despite, yes, there's certainly concerns about delinquency rates. There's concerns about, the student loan delinquencies and some other things that are going on, auto loan delinquencies. But consumer credit's still expanding, and consumer credit's important to the overall economy because that's where buying power comes from, right? So as homeowners and individuals, et cetera, are going out to, buy a house, buy a car, whatever it is, that expansion of credit is supportive for economic growth. And so, of course, when I'm buying something, I'm creating revenue for the companies, in the S&P 500, which improves earnings. That helps support the markets. Then, of course, and again, just talking about delinquencies, yes, we do have delinquency increases in student loan debt, which is, it's a significant number, but it's not a massive part of the economy. It is a significant amount of debt and will certainly impair what's going on with spending to some degree. But again, it's not a massive debt load of the entire economy. Also, we're seeing some rising, kind of delinquencies in credit card debt, but it's not back to all-time highs yet by a long stretch. We're kind of approaching where we were back in 2000 and kind of quarter one of 2010-11. But that is rising. Credit card debt delinquencies are rising. But if you take a look at the bigger debt loads, such as mortgages and home equity, revolving credit lines, et cetera, those delinquency rates are extremely low. So again, we do see some stress in the markets. I don't want to overlook that at all, but we're not seeing widespread stress yet. Now, what this data tells us right now is that the consumer is definitely slowing down. That's why we're seeing slower rates of employment growth, et cetera. In fact, Friday's article on the website is talking about the alternative employment sources, which also suggests that the Fed will cut rates this coming week because employment data is clearly slowing down a lot of fronts. That's weighing on wage growth. That's also weighing on credit card delinquencies and defaults, those type of things. But again, that stress as a function is low relative to historical periods where it's like, oh yeah, we're in a recession. It's definitely not great, but we're not in a recession yet. So again, the data right now remains supportive of higher asset prices, at least in the near term. And then most importantly, just statistical. If we've had a 20% drawdown earlier this year, right? And then the market came roaring back. We're up 17% for the year now. To have that type of reversal where you have a down greater than 15% year to date and then comes back to be up double digits, going back to 1950, that's only happened 3 other times. Over the next 12 months, the markets were always higher. Now, does that mean it's going to happen every single time? No, it does not, right? What this doesn't tell you is that, were the 2 previous years also double-digit years in 1982, 2009, and 2020? No, right? Think about the dates here. 2009, just coming out of the financial crisis, massive amounts of fiscal stimulus going on. And of course, in January, February of that year, the markets were down pretty sharply. And then the Fed steps in and we start having all these supports for the markets. Markets take off in March. So you had that big recovery. That was 2009. 2020, you know what happened, right? Markets down 35%. Fed steps in, massive liquidity, et cetera, so forth and so on. Markets recover nicely, start searching off. 1982, we're just coming off basically a recession in 1981. Ronald Reagan starting to do deficit spending, et cetera. So again, all that kind of makes sense. 2025, we've had 2 years of 20% return growth going into this year. Yes, we had the tariff blow off earlier this year, but we don't have massive Fed interventions. We don't have massive fiscal stimulus or monetary stimulus going on right now. In fact, we have the opposite. We have a reduction of liquidity. So there is risk that 2025 may not follow the path. But just statistically speaking, that correction kind of reset the table. We had very negative sentiment back in March and April, and that kind of reset the table for speculative risk taking. And so that momentum in the market could very well carry the markets over the course of the next 3-6 months as we get into next year. Doesn't mean it has to, but that's what you at least have to pay attention to. So that kind of makes up a bit of the bullish backdrop. And again, I've got some more in-depth analysis coming up, talking about valuations and other metrics, those type of things as well. We'll be going over those. But again, I had to keep the newsletter somewhat reasonable in length. So let's talk a little bit about the bear case. Bear case, of course, revolves back to valuations, which are certainly elevated. Bearish case also talks about the issues of, kind of this, over hype in the markets. We have just a lot of speculative extensions, et cetera, in the markets that are not necessarily great forward indicators of positive returns next year. But one of them, and I was just talking about this a little bit this morning, is just looking at the 3-year price return of the markets. Again, we've had just exceptionally strong years for the last 2 years, and this will be a third year, barring that we don't have a 17% decline between now and the end of the year. But if we crank out another 17, 18, 19, 20% return year, that will be 3 in a row. Historically speaking, we are very deviated from the long-term moving average right now, the 3-year moving average. Just from price returns, et cetera, that also suggests some risk to the outlook for 2026. And the price reversion to the mean is one of the most powerful forces in the markets. And again, just when you get extremely extended from long-term moving averages, those averages are going to eventually pull you back. That gravity will eventually pull you back. Something will happen, and you'll get a reversion back towards the mean. So, from just a purely technical basis, next year something certainly worth looking at. Valuations, as I said, are extremely elevated. And those valuations also weigh on outlooks, because when valuations are extremely elevated, and Brendan will fix this, he's working on fixing the graphic, just one second here. When valuations are extremely extended where they are now, that's a function that ultimately you're going to have a reversal in the markets, because again, all it takes is something that says, remember that valuations are nothing more than a measure of sentiment in the near term. Everybody's very bullish on the markets right now, where they're willing to overpay for assets on both a forward and trailing basis, because they expect that markets will continue higher next year. So why not? If I'm going to continue to get earnings growth and I'm willing to overpay for that earnings because earnings will catch up to what I'm overpaying for, I'll keep doing that as long as markets are rising. At some point, the valuations become problematic, because if there's anything that comes along next year that all of a sudden reduces forward earnings outlooks, then those valuations, what I'm paying for those earnings today, will have to be repriced. In other words, if I was going to make $100 a share this year, I'm willing to overpay for that. But if it's only going to turn out to be 80, I've got to adjust that valuation. And this is part of some of the analysis I've got coming up, is where we'll look at different valuation levels relative to earnings and what that risk may be for markets next year, and give you a range of outcomes. That'll be in the next week or so. I'll have that article out. But again, valuations are important because that's a measure of sentiment. And when the sentiment changes relative to what expectations are, that poses a risk to markets, because markets will have to be repriced ultimately for a new version of what valuations may look like. Also, too, we're starting to see, one of the things that really hasn't shown up a lot yet, but I think is going to, is stress in the private credit markets. There is so much money piling into private equity, private credit, and now Wall Street, as we've talked about before, Wall Street's trying to push private equity and private credit into your 401k plan, because they need to offload this stuff to somebody. And that's how they make their money. They need to get out of these products, so they have to offload that to somebody. So they want to offload it to you and your 401k plan. Not a great idea, but we're starting to see stress rising, particularly in private credit. That's, as we talked about before, one of the things that will impact the markets is a credit-related event. Now, I'm not saying that private credit is going to be the issue, but this is one of those things, kind of those anecdotal indicators worth paying attention to, because it does suggest that things are not maybe as rosy as everybody's kind of pertaining them to be. So there's risk. And that's my whole point. There's just some risk that we need to pay attention to. Again, I'm not saying that the markets are going to crash next year, but I do think that there is a risk that seeing lower returns next year, and look, when I say lower returns, don't immediately run off the cliff and say, oh, Lance just predicted a 20% correction in the markets. I'm not saying that. But if you get an 8% return next year, that's going to be really disappointing in terms of what we've seen over the last 3 years. And there's a lot of investors that have never seen, a 6% return year. So, that could be a whole kind of shocking environment to somebody. Again, just, the risk next year is that you just have a lot more volatility. Now, as I was saying earlier, let's go back and just touch on kind of the aspects of the markets, right? For the bull case, right? We have, the fact that you've got, kind of liquidity, and you've got supports, technical supports, you've got momentum. Those are all fairly short-term in nature. Valuations, credit, those type of things, more fundamental factors, those are longer-term in nature. And this is an important thing. So now let's talk about the outlook for next year, how to position for this. Right? Rather than going into next year going, hey, I'm a raging bull or I'm a raging bear, don't do that. Let's go into next year understanding that the bullish supports for the markets are currently present, right? We have liquidity, we've got momentum, we've got sentiment, all in favor of the bulls. So at least for the first quarter to first half of the year, the market looks pretty good to the upside. Fundamentals, credit, technical deviations, those type of things, those are a little bit longer term in nature. So those may not show up until the latter half of next year. And this is why it's important to keep these factors all in mind, because we could have next year both environments come to fruition. We could have a bullish first half and a bearish second half. We could have a bullish year next year and a bearish 2027. The timing is going to be the very difficult part for investors. And it could be a bullish first quarter and a bearish second quarter, right? I don't know, right? Because there's going to be some event that comes along that triggers those bearish catalysts of the markets. And again, you strip out everything else, right? The private credit, the deviations, those type of things, those are all catalysts. Because ultimately the correction will be a reversion of valuations due to a change in expectations for earnings. That's going to be the issue. That's all that whenever you have corrections in markets, whether they're a 10% correction or a 20% correction or a 30% correction, it's always just a function of repricing markets for a change in expectations over earnings. That's it, no more, no less. And everything else, all the headlines, are simply the catalysts that are causing that change in earnings expectations. So you have a bullish first half because of momentum and expectations are still bullish. And then somewhere along the way, something happens, whatever it is, that changes those expectations, and that's how you get the bearish kind of second half of the year, or however it works out. And again, timing is going to be the terrible consequence of this, trying to get it right. But this is why we need to go into next year with kind of a basic game plan of just how to potentially navigate this outcome. So, maintain some diversified equity exposure. It's okay to have the Mag 7. It's okay to chase some AI technology stocks, but have some defensive holdings in your portfolio. Have some bonds, have some kind of defensive stocks, your boring Berkshire Hathaways, your consumer staples, things like that are going to hold up if you start getting a bigger reversion in the markets for some reason. Keep some cash. Cash gives you optionality. So when something happens, I've got cash to buy some assets cheaper. Again, whatever, this is one of my big complaints about people that always have bearish headlines. I got an email over the weekend. It's like, hey, what do you think about this person's view? Well, they've been bearish for like 5 years. And every year is going to be the year that the world falls apart and there's going to be all this loss in the markets. But yeah, I can, just predicting that every year is great. But two problems with this is, one is that, yes, eventually you're going to have a market correction. We had a 20% correction this year. Nobody was predicting it, right? So you have the correction. That's great. So everybody's predicting, hey, markets are going to crash by 50% next year. Okay, fine. Let's go with it. The one thing they never do is tell you, is like, okay, we had the 50% correction, time to buy, right? They're always happy to tell you to sell, but they never tell you when to buy. And they're always bearish. Even when you have a correction of 20%, they don't flip the script. They're still bearish, right? Oh, the markets are going to crash. Okay, when is it going to crash? Why is it going to crash? And when do I need to buy? That's what I need to know to be a long-term successful investor. And this is why I try to, here on the show, myself, John, Danny, Michael, we try to, and again, just like this whole, I got an email, it's like, can't you just pick a side? You're always like both sides of the fence. Yes, markets go up and down. Yes, absolutely, they go up and down. And so our job as investors is to navigate that. And I'm not smart enough to tell you exactly when the markets are going to correct. I just can't do that. What I can do is understand when they are starting to correct, I can reduce exposure. And then when they stop correcting, I can increase exposure again. So we're just trying to help you navigate that. Well, one thing that cash gives you is optionality. And, one of the big fallacies about cash is this. Well, if I have cash in a money market, I'm losing purchasing power to inflation. No, you're not. If I have cash in an account for a month or 2 or 6 months or even a year, I'm not losing that much purchasing power because I'm getting some type of interest on my money market, most likely, right? Inflation's 2.5%. So I'm not losing that much money keeping optionality in my portfolio, because when I can get that money invested at a better rate, I'm going to make substantially higher returns over inflation in the future and make up whatever minor bit of purchasing power impairment I may have had over the last 6, 8, 12 months. When you're talking about keeping money in money market for decades, yeah, that's a problem. You're going to lose purchasing power if you've got money just sitting in a cash in a tin jar underneath your bed, buried in the backyard, wherever it is. Yeah, you're going to lose purchasing power if you keep it out there for a decade. We're not talking about that. We're talking about keeping cash handy for opportunity. Because if I don't have any cash available when there's an opportunity, I can't participate. So that's what I have to have some optionality for. So think about cash. It's an asset class. Focus on companies with strong free cash flow, balance sheets, low leverage. That'll help keep you out of trouble when markets decline. Again, that bit of diversification in your portfolio. Monitor the credit markets. Again, if you're going to see any type of event that leads to a very big risk-off catalyst, it's going to show up in the credit markets. So pay attention to credit markets. Watch credit spreads. On Simple Advisor, we've got a whole page now dedicated to credit spreads. They're not showing any risk right now. Doesn't mean they won't next year. Again, don't forget hedging. Just some modest hedges in your portfolio. Buy some out of the money S&P puts or write some covered calls against stocks. You don't have to be, super technical about it. Super sophisticated about it. You're just buying some insurance against the decline. That's it. And yeah, that money's hopefully that money goes to zero. Hopefully that insurance turns out to be worthless because the markets went up and you made a lot more money than what little bit of insurance you paid and cost-wise. Hopefully that's the way it works out. And you got a tax loss for the year for that item to write off against your gains. But just in case markets do something unexpected, you've got some protection. So that's the thing to consider. Sharps Law says he has no interest in crypto, so he's not coming to the summit this year. If you haven't gotten your ticket to the summit, be sure and get it now because tickets are going fast. And Sharps, we love you, man. You're awesome. I love meeting you at the summit and visiting with you. But we have more than just crypto going on at Summit. It's just one guy talking about crypto. You can step out and go get some coffee and a donut, whatever we're serving for breakfast or brunch while he's talking. But yeah, we've got Brian Dunlap from BlackRock. He's talking about AI and what's happening in the crypto space, not the crypto space, sorry, the artificial intelligence space next year. Infrastructure as well. That's going to be all the data center build out, what to expect. Ed Slott covering everything about financial planning. He's much more entertaining than Danny and Richard. So, you'll certainly want to be there. Then, of course, Michael Leibowitz on fixed income expectations for next year under the new Fed chair. And then, of course, I'll be covering the markets, economics, everything else. So, again, and Adam Tagg will be there as well. So, Sharps, if you don't come, shame on you. there's a lot more going on than just crypto. Anyway, but make sure you get your tickets. They are going pretty quick, and we are going to fill up pretty quick because sales are going well right now. So again, get your tickets. They're online. Just go to realinvestmentadvice.com. Oh, sorry. Sectors and stocks for next year. That's going to be the big question. And again, we talked earlier about potential for volatility risk next year. Again, making predictions are a fool's game. And, when people come out and say, oh, next year it's going to hands down be this or that, odds are pretty high they're going to be wrong. That's just the way markets operate. However, statistically speaking, and just fundamentally speaking, going into next year, and this is why we've started making some minor adjustments to our portfolio recently, adding in some more dividend yield, a little bit more defense into the portfolio. I think that next year, if we have slower economic growth, if we see a reversal in earnings expectations, I'm not talking about a collapse in earnings expectations. I'm just talking about going from, say, $330 in earnings next year to $300 or $290. If you have a negative revision in earnings, and analysts are always too optimistic, right? So they're always going to get revised lower. If that occurs, then growth stocks are likely going to come under pressure. Now, it doesn't mean that they have a bad year. It just means that maybe there's more volatility and they don't rise as much. I think that next year, having an allocation to some defense in your portfolio, so think about staples, utilities, real estate, those type of things, could pay to have a little bit of volatility protection in your risk. Now, again, I'm not saying go sell your gold, go sell your growth stocks, go sell your NVIDIAs. I'm not saying that at all. We're still probably going to own those companies unless something, goes wrong. But you want to kind of pair that risk exposure because of the correlations that you've got in those stocks and those asset classes in general. That's a near one correlation. You want to kind of pair that with some stuff that is not not correlated. It doesn't have the same correlation, because if there's a rotation in risk, it's going to move to a risk off position, and those are the stocks and sectors that should perform well. Interest rates will be lower. If the Fed comes in, starts cutting rates, and again, with this change potentially to Kevin Hassett or Kevin Warsh, and right now Warsh is in the lead, that's going to probably promote, there's probably be further rate cuts next year, maybe not aggressive rate cuts, but again, we see 2 or 3 more rate cuts next year. That's going to bring down the short end of the curve. If the economy slows, and that's what employment's telling us, the long end of the curve is going to come down. And so that's gonna feed into that defensive nature, right? So real estate should perform better next year. It's had a tough year because of rates. If rates come down a bit next year, we're going to see a little bit better performance in things that are affected by lower yields. So think utilities, think real estate, those type of things. Utilities should also benefit from the data center build out, electricity demand. Utilities should perform better. So again, there's some reasons to think about a little bit more. And again, I'm not talking about switching your whole portfolio to defense next year. There's no evidence of that. But maybe starting to add a little bit of base in, a little bit of structural support. This is what a good hedge fund does. A good hedge fund just manages risk, right? So they've got a lot of growth exposure, then they go arb that out through some other type of asset, right? They'll go short treasuries or short, whatever it is, to arb out any risk that they've got on the other side of the portfolio. That's called hedging. So that's why hedge funds do well and they're successful over time, and that's why they have a lot of capital, because that's how performance rules. So think about your portfolio kind of like a little mini hedge fund, and just think about adding some arbitrage, risk management in your portfolio by just thinking a little bit, kind of ahead of the game of what the risk might be next year. Got a good question here about energy plays next year. And there's some energy plays, like for instance, in our portfolio, we're long Kinder Morgan Energy, GE Vernova, AES, AEP, and Duke, right? So we in 2 different portfolios, we own different energy stocks, but so we own some utility, some energy in both portfolios. The thing I'd be careful of is there's a lot of speculative trading going on in companies like Oklo, The problem with Oklo is that they have absolutely no sales, right? It's all a bet on a future outcome. And there's so many things that can happen between now and if and when they ever get start generating some revenue. And again, they will at some point. I'm not sure why they're public at this point, considering they have no revenue. But it's kind of like a stock should be public when you have revenue. But again, it's a good speculative trade. So if you want to spec on Nuke, that's fine. Just that stock just had a 50% correction. So there is a lot of risk in companies like Oklo that have no actual revenue at this point. Conversely, if you want to play nuclear, buy Energy or Constellation Energy Group, GE Vernova, that have revenues, I think is a little bit safer play. And so if you're kind of looking into next year, I think there's two places you want to kind of focus on. One is on the utility provider side, because they've got to deliver the utilities have to deliver the power to the data centers. Electricity prices are going up. That's going to be good for utilities next year. And the more demand that we have for AI data centers is going to be increased demand on the electric grid that we don't have in place right now. The electric grid is just not in place to deliver that kind of power generation. So on the other side of that, think about natural gas pipelines, because these, as we talked about before, the data centers are going to have to connect to the natural gas pipelines. We wrote an article on the website talk about behind the meter. So if you just Google behind the meter on our website, you'll see the article, but talking about how these data centers are going to have to attach to pipelines in order to generate electricity for the data center until the grid is built. So I think there's really kind of two plays for next year. Bloom Energy is another one. But you've got to be careful with that one. It's like way ahead of its fundamentals. So just again, I think fundamentals are going to apply at some point next year. But I think you definitely need, to your point, I think you definitely need to have some exposure to that area, because the data centers they're coming. As I talked about before, my wife is currently working with data centers right now to provide LNG, to provide a temporary power solution until they get onto the pipeline. So there's all these kind of layers that are in there, and you just need to be kind of aware of that. So, but I think it's a good idea. All right.
So what do you envision for rates after Powell?
Yeah, I've got a whole list. You're missing a few. Let's go back to the top of the list. I've been over here while you were talking about whatever you were talking about.
Well, these are the top of the list. But yes.
Gold and silver next year. What do you expect? I've got an article coming out talking about margin debt. There is an extremely high correlation, and it's not surprising, between price increases and margin debt, right? Because you're buying things on leverage. So if I can use leverage to buy things, then that increases the overall rate of what I can buy. So it increases demand, so prices go up. What drives the price of gold and silver and stocks and Bitcoin and, at the end of the day, everything else? Is it a narrative, or is it supply and demand? It's supply and demand. So if there's more buyers than sellers, the price goes up. That's why markets go up in price. Markets will go up more if I can create more demand for those shares by doing it on leverage. So it is not surprising there's an extremely high correlation between margin debt levels and the rate of change in margin debt versus gold versus silver versus stocks versus Bitcoin. Very high correlation. So if this is the big risk next year. So this is if you did not read this past weekend's newsletter, we didn't get to have a show on Monday, and so Monday's show was called the Double Bubble. The Bank of International Settlements just did a really big report on gold and gold and stocks, and historically over the last 50 years, this should not be of any surprise to anyone listening to the show, is that when you have asset classes have a correlation of 1, when something happens that causes a reversal in one of those correlated assets, they all go down at the same time. And so next year, your big risk, particularly when you're looking at things like silver and gold, which are extremely overbought, extremely deviated from long-term means on a monthly, when you're talking about monthly data, right? We're not talking about daily trading, but when you're looking at long-term trends, when you look at monthly price deviations from long-term means at the levels you're seeing in gold and particularly silver, but also stocks, the risk of reversion is much higher. And so that risk of reversion is magnified if you also get a liquidation event that occurs that reduces margin debt, because now I've got to sell more to cover my margin. So again, if you didn't get a chance this weekend, this report by the Bank of International Settlements that we covered in the newsletter, let me see if I can just grab one of the charts from them real fast, is a good read. And because again, if look, we're long gold and silver in our all-weather model. We've taken some profits recently, but we're still very long those metals. We're also own uranium. We also own other stuff as well, which have done exceptionally well this year. That portfolio is doing fantastic. But the risk is, as with all assets, is of reversion. Narratives are just the rationalization for why something's doing something, either going up. If it's going up, we come up with a rationalization why it's going up. It's debasement, it's whatever. If it's going down, we come up with a rationalization for why it's declining. But at the end of the day, just remember what drives price, and particularly on an asset like commodities or silver in general, gold in general, it is all supply and demand, and it's all traded on futures. So this is all of what's happening on the CME at the end of the day. So if anything occurs that causes a reversal of expectations, you're going to have a correction. And this was one of the charts that we showed. So this was a chart that we put in a newsletter this weekend. And this was a note from the Bureau of International Settlements that said, for the first time in over 50 years, both gold and equities have shown similar explosive behavior. And here's the chart that you can see is this is exactly diamond. So this is stocks versus gold. And you can see that since 2014, they were traveling in kind of a rising trend line. And then since 2020, the October bottom in 2022, everything has just exploded higher. And that's okay, right? There's nothing wrong with that. It's been great. It's been a great ride. Everybody's making a lot of money. It's awesome. Just be aware of that underlying risk that eventually you are going to get some type of reversal that causes things. Oh, I did publish these charts. Sorry, I didn't realize I knew I was going to publish these, and I published them. I write so much stuff I forget where I publish stuff. This is in last weekend's newsletter, but this is a chart of margin debt. This is the annual rate of change in margin debt versus the S&P 500. So what you can see is there's this is the chart on the left, margin debt versus the S&P 500, very, very high correlation. Margin debt versus the annual rate of change in silver on the right, very high correlation. And then we also see the same thing. Brandon, I'm going to change one more chart. We see the same thing in, obviously, gold prices. And so you just went to a different graphic. There you go. This is brought to you by our advisors. You also see the same correlation between margin debt and gold. So again, the thing to be paying attention to, whatever your expectations are for next year for commodities, gold, silver, stocks, Bitcoin, it doesn't matter the asset class. If it has a correlation of 1, pay attention to margin debt. That's going to be, and we're not talking about the level of margin debt. We're talking about the rate of change in margin debt. If the rate of change in margin debt begins to reverse, that's going to be problematic for all risk assets. So kind of going back to that fund strat post that I showed you on X a minute ago, kind of that mean reversion during the course of 2026, that would likely be across all asset classes at one time. So again, that's just from a risk management standpoint. That's what you want to be careful of in 2026. Again, does that have to happen? Absolutely not. I'm just saying if you pay attention to the rate of change in margin debt, it can help you navigate risk assets. And these are all, stocks, gold, silver, platinum, all these type of things that are going on with precious metals. That's just a chase to get exposure, and that supply-demand imbalance is what's driving the prices. So if anything happens that reverses that demand, you're going to get a correction, and that'll be the thing to be paying attention to. Here's a good question for you, Danny. What investment should not be held in a Roth IRA?
Ooh, this is a great question. So in general, we want to think about tax efficiency. Now, the IRS is going to have a handful of things that you cannot or should not hold inside of that Roth IRA or IRAs in general, like S corporations, collectibles. You may not want to hold penny stocks. And then depending on what or how you want to use real estate, you want to be mindful if you're getting something that's going to be depreciated quite a bit. Do you actually want that in the Roth IRA? Now, you may have high expectations for future growth, great. However, if you're looking at it, which most people are, they want that depreciation. From a tax perspective, may not be the best idea to hold all types of real estate or business investments inside of that IRA. Outside of that, you may want to be cautious of a company that may have IBDs, things of that nature that you want to capitalize on. And at the end of the day, make sure that you can take full deductions. So the Roth IRA, albeit I really love, right? I'd love to be able to have most assets inside of it because you get that tax-free growth. We're not worried about capital gains, not worried about any interest or dividends from a taxation perspective. And when you take the funds out, unlike the traditional IRA, we're not paying ordinary income taxes on it. You can make an argument it's actually better than even taxable funds for the most part. But if you're utilizing these and trying to get very strategic from a tax perspective, there may be some areas or some positions where you would not want to hold inside of that.
That's right. And again, it's anything that, again, this is IRAs as well.
Yeah.
You don't put real estate inside of an IRA. You lose all your tax deductions for owning real estate. But I see this a lot with people doing that. Oh,
in fact, yeah. I mean, I can tell you we have a lot of clients who have in the past done, multifamily investments, other types inside of traditional IRAs. And like, oh man, why did I do this? Because, when they go back to refinance this, you're not getting the most bang for your buck out of it, plus the deductions along the way. So most of those clients we visit with, they've been like, man, I wish I would have never done that inside of that IRA account. So in general, we typically advise not to. But yeah, it's a great question.
I hope this analysis helped you out this morning. Again, I've got lots of articles coming up on this over the course of the next couple of weeks, talking about our outlooks for next year, kind of how our investor resolutions for the year. I repeat that every year to kind of give you all a fresh reminder of the things that we need to be doing in our portfolio. So I'll have those all available for you shortly. They'll all be at the website. Again, if you here, I'll just show you where to go on the website. So if you go to our website, and Brent will bring this up here, and so I'll just kind of walk you through this real quick. If you go to our website, this is the homepage of our website. Make sure and sign up for the summit while you're here. The link's right at the top of the page. But if you scroll down here just a little bit, you're going to get to market commentary and research. But you get to market commentary and research right here. And what you'll see is our daily market commentary, our blog, our real investment show, weekly podcast, and subscribe buttons along the bottom. So if you just subscribe to the ones you want, we'll email you all this commentary. Also, again, I post all this commentary at Lance Roberts on Substack. You can subscribe there. Also on LinkedIn, you can subscribe there for the newsletter. But again, easiest to do it just on the website. We email it right to you when they get published, so you get first look at them. Or you can always come to the website, realinvestmentadvice.com, and get those while you're here. Be sure and click the Connect with Us button. Let us know how we can help you. Always happy to do that. And again, while you're here, don't forget, get your ticket coming up January 17th so that we can see you at the upcoming Economic Summit. Love to see you there. It'll be a really good event. All right, y'all have a great day. Be back tomorrow with Two Dads on Money. John and I will be talking about credit a little bit tomorrow. So again, we've got a couple of things to go over with you guys tomorrow on Two Dads on Money. That'll be John Penn tomorrow. We'll see you then. Have a great day.